Hi everyone, Michael from Bullion Now, bullionnow.com.au. So we released a video late last week-ish entitled What's Happening with These Banks? And it's caused a bit of a stir. So we thought we'd sit down and have a bit of a yarn about some of the comments on there, because some of the comments, I've responded to a few of them, but some of them are getting quite long responses. So I thought we might be able to quicken it up a bit and actually make it a bit more relevant. So for those that are either not aware or living under a rock or something like that, over the last few weeks, obviously we've had quite a lot of ructions in the banking industry. Certain banks in the US have collapsed. Credit Suisse in Switzerland has obviously been taken over by another company, by UBS. We've seen Silicon Valley, which collapsed initially. All its assets and everything have been assumed by another bank in the States. We've had quite a lot of comments about the fact that people are drawing their money out of the smaller regional banks, putting it into the large bank, and the large bank is taking their money and putting it on deposit with the smaller bank again. So we're setting up this feedback loop. We're also seeing a lot of massaging messages out of a lot of the people that know, so the politicians, the banking officials, things like that, where they're trying to calm the waters. They're trying to stop people stressing about it by making the right noises, which is actually their job. Don't get me wrong. I'm not criticising them for it at the end of the day, but it's a little bit like me when I'm trying not to get my kids to panic and I'm distracting them over there while I'm hiding the fire in the corner, sort of thing. It's like, don't look over here. Look over here, kids, where it's nice and calm. And that's kind of what they're doing now, while there's a bit of a fire burning in the corner. So it's the video that we discussed where we actually talked a little bit about fractional banking and a bit of the responses and what's going on has actually generated, like I said, quite a lot of feedback. So I just thought I'd like to hit on a few of those comments as we go through, and we'll try and keep it fairly short and sharp. There's one I'm going to start with, and it typifies. Let me read it first. So this is from Old Asia Hack. Yes, but you did not mention that buying gold at the wrong time, that you could be losing money for decades. Look at the price of gold in Australian dollars in 1980. The price of gold almost touched $800 Australian. Then it went down, and there was 26 years before the price of gold hit $800 again. That means your investment went nowhere for 26 long years. Had you invested in real estate or even just common term deposits in a Commonwealth Bank, for example, you would have had far better returns. Metals can be good, but not real good if you were buying at the top end and then waiting 26 years to get your money back. This typifies a lot of knee-jerk reactions, both towards gold and away from gold. And it's cherry picking, and it really frustrates me to a large degree. And I'm not saying that, he's wrong, you should buy gold. What I'm saying is this person is whatever investment we're talking about, whatever hard asset we're talking about, you can cherry pick certain points and you can prove almost anything. Because I did a breakdown. This person has mentioned, I don't know if it's a male or a female here, in 1980, price of gold almost touched $800. Now, I went back over the old data and I actually pulled it from the Perth Mint, so it's government sanctioned data. They have a breakdown of every price in US dollars, Australian dollars, euros, and another currency, I think, for every day. It goes back like 40 or 50 years, and it gives you the high and low for that day. Sorry, the bid and the ask, I think it is, for that day. So, according to the Perth Mint, the highest price, my apologies, I didn't put my phone on silent. The highest price for gold in 1980 was $752.50 an ounce on the 21st of January 1980. It stayed above $700 for a grand total of 2 days for the whole year. So you would have to have timed it very poorly to actually end up on the high side of the spot price for that year. The lowest ask for the year was, so I've gone on the ask price, which is always the higher between the ask and the bid. So I can actually find lower bid prices if I wanted, but I took the worst case scenario. So the lowest ask for the year was $436, and that was on the 18th of March. So within 2 to 3 months, it was well down on its lows. So that's how dynamic it was. it spent most of the year between 5 and 600. So if you'd bought on the 18th of March, within a month or two, you could have sold and earned yourself somewhere between a 25 and 50% return. And there is no way on earth you would have got that in a bank, even the Commonwealth Bank at that time. So we can cherry pick examples and we can prove whatever we like with this. But if you look on an overall term, it spent most of the year between $500 and $600 with major excursions below 500. So there were many opportunities where you could have bought below that $500 an ounce mark during that year alone. Within less than 6 years, it was back above 600, and there were many opportunities in the between years to exit at a profit depending on your purchase price in 1980. And this person is correct. If you'd picked the exact peak, if you'd done the trade at the exact peak, you would have been 20 years before you got your return back. But if you'd timed it in any other moment throughout that whole year, other than those 2 days, you would have easily got your money back within 6 years. Easily got a return within 6 years. You also have to understand that the period that he's picked from 1980 to 2006 is the peak period for the central banks dumping gold into the world market. So you've got this basic supply-demand pressure occurring in that time anyway. The fact that gold held up as well as it did, so effectively, if you'd purchased anywhere in that period other than those 2 days, you would have got a decent return within 6 years. And we got to remember, it's not just mum and pop people selling. This is central governments, central banks unloading humongous amounts of gold. That kind of pressure, it still took only 6 years at a worst case scenario other than those 2 days. It just took those 6 years to actually get that return in the worst period you could have for gold. The other thing that he's done in this time, or this person has done in this time, is he's actually cherry-picked the peak period for interest rate returns. It was between that 1980 and 2006 that we were seeing double-digit interest returns on your bank account. Never happened before, never happened since. But during that period, so he's taken the worst period for gold and compared it to the best period for deposit returns in the bank. So it's completely unfair. It's not a realistic comparison, even slightly. And I'll guarantee you during that time that I would be able to pick properties. Even now, I can pick properties, and we've just come through one of the biggest booms in history. I can pick times where you could have actually made a loss, a far greater loss than you would have on gold or anything else, if I cherry-picked those times and those examples. So don't fall into this trap is what I'm coming back to. You have to look at what's happening out there as a generalisation. You have to look at the movements in the price, and then you have to look at the trends and the emotions and feelings that are going on at the moment. Yes, we're at an all-time high at the moment, or we've just moved off the all-time high. In Australian dollar terms, that is, or very close to if it's not. Is now a good time to buy gold? Probably not. If your intent is to hold it for a week, a day, a month, even 6 months, it may not be a great time to buy it if you're looking for that cryptocurrency style trade. If you're looking for long-term preservation of wealth, the last 5,000 years, the trend, the emotion, all of that for the last 5,000 odd years shows that even if I buy it at the peak today, I'm not going to be too stressed about it in 10, 15, 20 years' time. I can go back 20 years and take the peak. So his peak in 1980, so that's 40 years ago, 43 years ago. His peak at that point, or the peak at that point, was $752. How devastated would you be if your buy-in price today was $752 Australian? You wouldn't be even slightly devastated. So look at the trends, look at the emotions, make the decisions from there. Don't cherry pick. This is the best, this is the best. Work on those averages. Look at it in context over the time. I think I've harped on this one enough. Let's move on to some of the other comments, because there's some really good comments in here. So just goes to show the term "trash is trash" has never rung more true. This is from Wombat. Totally agree with the sentiment of it, but I think as a culture we've moved away from what cash was actually originally designed for. I owe you $100. Here it is, transfer of wealth. It was never really designed as a store of wealth. I'm going to hold my money in this fiat currency. It was never intended that way. So if that's your intent, is to hold cash as a storage of your wealth, you are using the wrong thing. It's like trying to use a sieve to drink water. Yeah, you'll get a bit here and there, but you'll spill a heck of a lot, and it doesn't work very efficiently. So a lot of people saying, thanks for the explanation. You are absolutely more than welcome. That's what we should be doing far more of. This is from Tones the Breakdown. I do believe that the banking system is still bewildering. It absolutely is. They cloak it with smoke and mirrors. And again, despite what I said at the start, where that's the politicians and the bank leaders' jobs to kind of distract us and say it's all okay, a lot of the times they do it by introducing these smoke and mirrors. And that's wrong. They should be educating us. These are the reasons why it's secure. It's not just let's fuzz it all up so you can't actually make a clear decision. Let's break it down into nuts and bolts. Not everybody is going to, in theory, draw their currency out at the same time. Yes, we've made a mistake by buying these bonds, but if we allow it to play out over time, we know they're going to pay out, and they will pay a lower percent than if we bought them today, but the money in them is still secure because the basis of those bonds that they've got is still quite secure in the system. There are risks, absolutely, but the problem is more the fact that everyone is taking their money out of the system because they don't trust them, because they cover it in smoke and mirrors. Okay, there's a number of comments on here, and without knowing the ins and outs of the specific banks, it's a bit hard to comment on, but rumour has it, this is from Twin2, Silicon Valley Bank was missing their VP of risk management, and they could have managed the risk, but the person quit and wasn't replaced. Look, even if I'm not saying this isn't true, even if it is true, this is certainly something that any bank need to be monitoring their risk. Even as a small company, we're constantly monitoring our risk factors, and that can stretch from anything from supply chain issues through to having too many orders in with any one refinery at any one time. Because if that refinery goes belly up, because the same as when you buy something or when you pre-order something from us, you pay for it straight away. When we order from a refinery, we pay for it straight away, even though they may not deliver for, a day, a week or a month, or the overseas stuff, it can be 6 months before I see it. So we tend to manage our risk. Okay, we've got a lot of exposure to that company. We need to now start moving our transactions over to this other wholesaler or this other refinery to start reducing the risk on that side. So I would argue whether they've got a VP of risk management or not, it's an integral part of any business, whether you're a milk bar or whether you're a bank on a worldwide scale. It's irrelevant. Moral hazard and bad regulation have caused this mess, and inevitably more will come and make it worse. If anything history has taught us is that it may not repeat itself, but it constantly echoes through time. A lot of these comments that are being made, and I mentioned this on a live stream, I think it was a couple of weeks ago, my own family's experience when I was a teenager with Pyramid Building Society, and also I observed the State Bank of Victoria going pear-shaped, and the fact that it was government guaranteed and all those types of things. I'm not going to rehash it here, but the same comments and the same things are being done about it than were done back in the I was a teenager, it would have been the mid-80s, mid-80s sort of time, mid to late 80s. It's exactly the same. So we're seeing these echoes time and time again. And while we didn't have it hit hard in Australia, certainly these echoes were in the States particularly, but the States and Europe during the global financial crisis. We seem to see these things come and go every 10, 20 years or so. DA, point of order, Michael, it's not fractional reserve banking in Australia. Since 88, there has been no reserve. It has been the same in the US since 2020. It's fictional reserve banking, not fractional. All right. I'll give in on that one. This is roaming alone's actually highlighted something as well. Those in authority have zero accountability the higher up you go. And he goes on to talk about, no confidence in the banks. This is absolutely a valid argument, and we've seen that play out. We saw it play out with Credit Suisse, and I believe that one's going to play out for a number of years coming, because what they've done is they've completely turned the basic ownership structure on its head. For example, when you you have three different layers here, and I'm breaking it down. I know it's more complicated than this, but breaking it down into everyday basics, you have three levels of risk here in a banking situation. You have the depositors, you have the bondholders, and then you have the shareholders. And I know there's grey areas in there. When you deposit your money in the bank, you're becoming a creditor to that bank. They owe you those funds. So you are the top of the Christmas tree there. They will return your funds first. The next layer is the bondholders. So the bank says we're going to pay a slightly higher interest rate to the bondholders, and they will guarantee their money back. So they take a higher risk. Then you've got the shareholders. They own the bank. They're taking the highest risk of all. So they get a higher return. And if you look, even in Australia, you look at Commonwealth Bank, their dividend return is far higher than their deposit return. Their deposit return is far lower than if you're taking one of their bonds that they release. So this is normal across the world. But the risk factor goes up. So if you get more return, you are taking a higher risk. So when a bank goes broke, normally they pay back all the depositors first with the funds that are left over. Then they take whatever funds after that are left over, they apply that to the bondholders, and then if there's anything left after that, that's applied to the shareholders. Credit Suisse, however, and the Swiss government decided to pay back all that, like secure the shareholders, ensure the deposit holders, that's fine. They then gave the shareholders a chunk of money, so their price, I think their share price dropped from something along the lines of about $7.50 or €8 one day, and on the Monday they were worth about $3, I think it was. I've got those numbers wrong, but you know, it went from an $8 billion company to a $3 billion company basically over the weekend. So the shareholders got a kickback. They kept their money. The bondholders, the guys in the middle, they got written off. A good chunk of their bonds, it was a certain type of bond, but a good chunk of those bonds were actually written off entirely. So they lost their money. So the fact that they took a lower return because they were taking a lower risk has now been turned on its head. And I believe that this is going to end up chased all the way through the courts because there's a lot of big money has lost money. Secure money are the banks, are the superannuation funds who are mandated to invest not in shares because they are too risky. We're going to invest in bonds, have actually lost their money, and the shareholders have held theirs. So they are going to start pursuing, I'll guarantee you, the Swiss government and that whole umbrella there, they're going to start pursuing them through courts to say, this wasn't the deal. You can't do this. You need to make this right and compensate us for it. So this is not a good situation. The other situation you've got with this, and this comes back to, again, the higher the authority, the less accountability, is you've now got bank managers sitting there, not literally but figuratively, sitting there going, I've got all this money, my bonus is based on a return on this money. Now I know that if I take all this money and I go down the casino and I put it all on black, if black comes up, I'm the greatest person on earth and I get a massive bonus. If black doesn't come up and I lose the lot, I still get my wage, I don't get the bonus, and the government will bail out the deposit holders. This is not a good situation that we're starting here. The precedence is not good at all. Moving on, this is why we went on to doing this live rather than me typing it out, because I'd be here all year. Interesting video. How does one justify purchasing bullion at this time with the huge surge in the price of gold, especially over the past couple of weeks? This is from Julia Oz. And I think this is a really good question, and it's one that we get in the shop all the time because people are saying, it's at an all-time high. What do I do? Like, it's right up there. It's run really hard these last few weeks. Am I going to buy it today and it's going to fall out from under me tomorrow? And the answer to that is maybe. None of us have this crystal ball. Otherwise, we'd be, if we had a crystal ball and I could answer this question, we'd be videoing this video, if you can use that term, we'd be shooting this video on my private yacht out in the Mediterranean somewhere. That's not happening, obviously, so my crystal ball is broken. What I can say, though, with fairly decent certainty, and I've said this time and time again, is if you look over time, you can look at the longer term trends. And the longer term trends are, even if this is the peak, even if you bought on that day that is the peak for the whole year, it's the worst day on earth, you possibly could have paid, you could have bought gold on that day, over time, so long as your time period is not the next day or the next week or the next month or even the next year, that you are going to get that return. You are going to maintain that purchasing power over time. And we've proven this time and time and time again. So I would throw back to Julia. What is your intent? What is your reason for buying it? Are you buying it because you want a quick flip? Then no, I don't think I'd be buying gold today. Are you buying it because you're trying to secure your wealth, take control of your wealth and put it into a physical asset that you control entirely? Are you holding it for a longer than, let's say, 5-year time frame? And if your answer is yes to at least 2 of those 3 answers, then I would say it doesn't matter. And we've actually, I might even get Rubes to link, if he can, link to a video down below where we actually talked about does price matter. A while ago, we did a video on this. And it's not a bad idea to have a refresher on it. I have a question. This is from Jamie Frost. How closely are Credit Suisse, the bank, and Credit Suisse, the bullion company, connected? I've always thought that anything connected to Switzerland was the pinnacle of quality. I don't want to burst anyone's bubble here. Swiss watches are still world class. The Swiss banking system, I'd say, is letting itself down over the last few years, I would argue. They have pulled back the curtain on a lot of the secrecy, rightly or wrongly. They have now, as we've just talked about, the shenanigans with Credit Suisse. I would argue that their banking system now has Swiss cheese holes in it, for a very bad pun. I don't think it's what it used to be. I think they're letting their credibility down. As far as their bullion goes, I don't know the internal structure. I'm fairly sure that Credit Suisse bullion side of it is actually part of the banking system. It's a separate department, but it's still all under the one umbrella. I still have no problem with Credit Suisse bullion. I have no problem with the quality of it. It's great stuff. I would buy it today. If it walked through the door today, I'd absolutely buy it. I have no problem with it at all because it's still 4/9 gold. No one's going to risk that reputation. And in fact, if anything, if Credit Suisse does disappear off the face of the earth, UBS decides that it's no longer worth anything and writes it off, you may even find that those bullion bars that have Credit Suisse stamped on them become collector features in the future. I doubt it, but it's possible. I think someone's having a go at me here. Stephen Bayer, it's been a while since you did a rant. It was a comment I made. I know it's been a while since I've done a rant. Didn't you do one the week before about the Perth Mint? I would argue that that wasn't a mini rant. I would argue that that was a major rant, and I wouldn't call it a rant. I was just really, really, really peeved at how bad a hatchet job the ABC News Network, so Four Corners in this case, how bad a hatchet job they'd actually managed to do. You can't do that by accident. You've actually got to set out to do it. So I'm not going to take that one as a rant. I'm going to take that one as a, are you kidding me here? Yes, Astro Boy SpaceX. Michael, did you see this? Silicon Valley Bank UK hands out $18 million in bonuses after HSBC rescue. I didn't see it. I don't know anything about it. Actually, I did go hunting for it. I think the comment I made there was it makes you cry, and it does. You just kind of shake your head and move on. And then they wonder why we're pulling our wealth out of the system and we're taking control of it ourselves. Self-managed super funds are growing like topsy. Monna Tramata. Question, what eventually happens to badly run businesses? Well, in a normal world, they go broke. It's survival of the fittest. In this imaginary world that our large businesses seem to operate in, is too big to fail. Doesn't matter how badly you run it. There's someone who's going to pick up your mess. Are any of the big 5 Australian banks run badly? No comment. No comment at all. How badly will a worldwide bank contagion affect Australia? More or less worse than the 2008 global financial crisis. I didn't panic then, and I will not panic now. It doesn't matter what sort of crisis is going on. Panic is not the answer, so don't do that in the first place. How badly would a worldwide bank contagion affect Australia? It depends. Australia was for all of those that can remember the GFC back in 2008, Australia was never really badly impacted by the GFC. Yeah, we had a few ripples and all that sort of stuff, but we didn't have the bank, we didn't have Solomon's, and we didn't have, Ruben, help me, who's the other one? The big American financial company that went pear-shaped. As soon as I get off camera, I'll remember it. I'm just having a bit of a seniors moment at the moment. But Lehman Brothers and those ilk that all collapsed out from under them. It was huge over there. What will happen in Australia if we go back? It depends. My concern is not so much the banking shenanigans that are going on overseas at the moment. My concern is more along the lines of the superannuation funds, because they either directly or indirectly hold bonds or unlisted assets that can't be quantified until they're sold as to what they're actually worth. Now, we're starting to see in Australia now, it's happening overseas as well, we're starting to see in Australia major impacts on the commercial side of real estate. So residential has, come back and possibly even looks like it's starting to bottom out and may even take off again. The commercial side has maintained its prices. It's never really come back yet, although it's starting to show the first signs of it now. Now, let's say we have I'm not trying to cause a panic here, okay? I'm just explaining the way these scenarios play out. So let's say we have the baby boomers all starting to retire over the next few years. We also have some that are starting to say, well, look, the world's just not really sure what's happening in the world there. I want to start pulling my superannuation money out just a little bit earlier than I thought. Or even some of the retirees that are currently claiming on their superannuation funds starting to say, look, actually, we're wanting to open our own self-managed super, or our own, we want to draw down that little bit quicker. So all of a sudden we start seeing a run, and I use that term intentionally but loosely, a run on our superannuation funds. Now, the super funds have to provide that money. They're obligated to. So the superannuation fund says, okay, there's all this money coming out. We need to start liquidating some of our assets. Now, until this point here, no one has had to go back and revalue the bonds or the commercial real estate. So if they go in and say, holy mackerel, we have to sell one of a group of our bonds, or we have to start selling some of our commercial real estate to satisfy these drawdowns that we've got on super at the moment, all of a sudden this goes to market, and now it's not the accountant or the valuer's estimation of what this is worth. This is now coming to market. This is actually what it's worth. This is what I think it's worth because I'm buying it off them, or another company is buying it off them. The other super funds are going to be facing the same situation. So they're not going to stump up over the odds. They're going to pay what the current market value is, or less if they can get away with it, if this is a fire sale. So all of a sudden, these superannuation funds or private investment or private equity funds, all of a sudden they're going to start having to actually put on their books, we valued this at $100 million, but we only managed to sell it for $80 million. Therefore, we've made a $20 million loss on this transaction, and we had to liquidate it because we've got a drawdown on the funds. Now that becomes public knowledge. It now starts this feedback loop, and we see more and more people starting to pull their money out of super. I know I'm in that sector of the industry that sees a lot of it, but we are seeing more and more people coming in saying, I'm pulling my money out of my super fund. I'm either cashing out or I'm setting up my own self-managed super. And that can come from anywhere from 20-year-olds to 80-year-olds. We are seeing more and more of that come through the door. We're not a big company. If we're seeing it, other people are seeing it, and other people are doing it. That is actually what worries me. Not so much how much the banking crisis from overseas will affect Australia. It's how much will that scenario affect Australia, because that will seriously affect Australia if we start getting these runs on super funds. The same for the 401k in the US, and most Western countries have the similar thing to what we term a super fund in Australia. All countries have private equity funds. This is where it's going to start getting interesting on an Australian level. Again, you can see why we're doing this in front of a camera. Greener makes a comment, unless the government makes you give it to them like they did in the US quite a long time ago. We overplayed this one a little bit, and I'm going to get a little bit of negative feedback from it in the chat down below, and that's fine. I'm quite happy to debate this one out. We've never really seen a government confiscation in Australia. It absolutely did happen in the US. It wasn't militarily enforced. So by that I mean they didn't go around banging on doors saying, hey, give us your gold, mainly because, and I'm interpreting history here to a degree, I wasn't there, but from my perspective or my interpretation of it, mainly because you don't knock on an American farmer's door and say, hey, I'm here to remove your assets, because you're likely to come up against the pointy end of best case scenario, a pitchfork, worst case scenario, something more lethal. No government has actually gone in with the stormtroopers and actually removed those assets. But even when they did do it, they actually paid, I know today it seems ridiculous, but they actually paid over the odds for the gold. They paid $35 an ounce. Gold at that stage wasn't trading that high. So you've got to take it in perspective a little bit, that even going on past history, if we want to say in days gone by they've done it, we've got to look at how they did it. They didn't enforce it. They didn't kick down doors for it. It was made illegal, but they paid a fair market. In fact, they paid over a fair market value for it. So precious metals, gold, is not the only hard asset out there. My argument would be, and you've got to remember, if the government made it illegal, I've got a hell of a lot to lose here because I run a business this side. So I don't say this comment lightly. If they made it illegal and they confiscated the whole lot and they made recompense, as history has suggested they will, I would roll that money almost instantaneously into another hard asset to preserve my wealth, because I don't trust the banking system overall or the investment system overall. And again, going right back to the start, cash is a form of transfer of wealth. It's not a form of storage of wealth. So my immediate reaction would be to put it into a hard asset. And I'd suggest the same for you too. Alrighty. I think we're pretty much getting to the end of most of the hard questions. Smith John, my hard assets are doing pretty fine right now. Why anyone would keep their money longer term in the bank, I don't know. And I know there's been a couple of comments, and I haven't really hit on it. People saying that's why I only keep $250,000 in an account. I go back to personal experience or my family's experience with, those guarantees are only worth a lot right up until the point where they're not. And as soon as imagine if in Australia, the Commonwealth Bank, put it in perspective, Silicon Valley, if it was an Australian bank, would be the 5th largest bank in Australia. So if it collapsed here, we are talking the likes of ANZ, Westpac, those types. Yes, they're higher value, but they're not that much higher value in total assets. But we're talking that kind of ilk. We're certainly talking bigger than Bendigo Bank, Macquarie Bank, those types of banks with their hard asset, or with their total assets in the banking system. So we're talking a major bank collapsing. If that happened in Australia, if we lost an ANZ or a Westpac, seriously lost them, I would question whether the government would have the firepower to say, here's your 250 grand. They will, going back into history, Pyramid Bank, State Bank, they did eventually pay back those deposits, but it was 10 or 15 years after the event. Are you really willing to wait that long for your $250,000 to come back into your possession? I reckon we can draw it to a close there, Rubes. What do you reckon? Yeah. So I've gone on quite long enough. I encourage this debate and these discussions that are coming in. Even if I've sounded like I'm disagreeing with the person who's made the comment, the fact that we're having this discussion is incredibly healthy. And it means that we can bounce off ideas, the old iron sharpens iron scenario, where we need these debates and disagreements. And more in our society, I'm finding that people are not wanting to have the debate. They're wanting to state their opinion. And if you've got a differing opinion, well, then you need to be shouted down and eliminated. I'm not trying to do that here. I'm actually really trying to encourage this debate. Let's have these discussions. let's put it down there. Make those comments down below. We will either comment on them, we'll type it out, or we'll jump online like we're doing now on a camera, and we'll have that debate again. And I'm more than happy to get involved in these real nitty-gritty conversations. And I don't agree with you, what about this? And well, I don't agree with you, what about that? And you're wrong here and you're wrong there. And I think that's great because it allows everyone to actually come up with a really sound opinion and to be able to move forward from there. That's it for now. We'll talk again very, very soon, I have no doubt. See ya.